Good morning, Mr. Chair and board members. Today is January 2026. Welcome to the investment meeting of the Teachers Retirement Board. I will call the roll. Kevin Loeb.
With pending reappointment, representing Mayor Madonna.
Thomas Brown.
Good morning, Thad. Present.
Anthony Giordano.
Tony Giordano, representing Chair of the PEP, Gregory Faulkner.
Controller Mark Levine.
Do I say I'm representing the comptroller's office? But I am present. Thank you.
Victoria Lee.
Good morning, President.
Christina McGrath.
Morning, President.
Mr. Chair, we have a quorum.
Great. Good morning. First of all, before we start, I'd like to wish everybody a happy new year, a healthy one, full of good things, happiness, and you all should have a good year. Thank you. And first investment meeting of the new year, we have a new administration and we have a new comptroller of New York City. So welcome, Mark Lee and Greg. And would you like to?
Oh, sorry, great.
Gonna do it in Spanish?
Whatever English you choose.
Okay.
I think protocol might require this be in English.
Okay. Thank you.
I'm very excited to be in my first TRS meeting in my new capacity. Hope to come as often as I can. It's hard with the schedule, but I wanted to make a point of being here as we start out the new year. It's been a joy getting to know the three elected trustees in recent months, and I have to say I'm pretty inspired by how seriously you take these roles and by the level of expertise you've developed. So for any TRS members who are watching from home, you all should sleep well at night knowing you have three people fighting for you and your assets. And I'm very much looking forward to working with all of you. Comptroller's office has many functions. There's almost no aspect of financial operations in city government that my office doesn't touch, from issuing the debt to managing the cash to approving contracts. But without a doubt, nothing is more important than my role as serving as a steward of the city pensions and ensuring that we maximize risk-adjusted returns for the people who have served our city and spent their careers working for us and now deserve to have a safe and secure retirement. I take this very seriously. And so working with you to achieve that goal is my top priority. I'm lucky that I have a wonderful team to help do that. I think many of you have met, but I want to reintroduce our brand new trustee, Amy Slattery, who is right here. Rare for someone in this position, actually an accountant, so quite qualified, and has been a very close professional partner for me for more years than ever that we would like to admit, I have to say, but you're going to love working with Amy. It was a close call, but we did decide to keep on the great John Dorso, who is here. So it's going to continue to be a vital member of our team, and I know a great partner for all of you. And this is your first meeting with our acting chief investment officer, Monty Tarbox, who could not have a more extensive resume that he's bringing to this. And in the first week of the job, told the returns are already up 200 basis points. Very excited for your work. Seriously, he's off to a great start. We also have a search underway for a permanent CIO. Now that's a more involved process. That's a national search. We've contracted with a major search firm to do that. So we'll keep you posted on that. But in the meantime, I feel really good about having Monty at the helm. So I think that's it. If I'm able to, I'll say another couple words when we're in executive session. But again, thank you. Couldn't be more excited to be here.
Thank you. Welcome, Mark. Thank you. Welcome everyone on Mark's team. Pleasure. So we will continue with the public agenda and start with the passport funds for November passport funds flash report. And Goldman Sachs, I think Amanda is going to be taking that. Thank you.
I'm gonna step us back to November to start. Our most recent final results for the passport funds as of the end of November. And if you think back to November, the first part of the month, first half of the month really was colored by the continuation of what ended up being a 43-day government shutdown. So not surprisingly, we see pretty muted results, especially across US equity markets, which really was similar to what we saw across the year, with non-US equity markets outpacing US equity markets, particularly emerging markets had a very strong year. We also, in November, had a bit of fluctuation in market consensus around what the expectations were going to be for the Fed rate cut or not in the month of December. That impacted some of market performance. And as part of the government shutdown, also had delays in some of the typical data releases. So all of that led to what ended up being a pretty underwhelming month in terms of returns. You can see for the diversified equity fund for the month, total return of 10 basis points. And really the range of returns across your funds for November, ranging anywhere from at the high 50 basis points for the balanced fund, and on the low end, down 1% for the sustainable equity fund. Looking out on the year-to-date column, though, through the end of November, very strong returns. Most of the variable funds in double-digit territory year-to-date through November, with the diversified equity fund up close to 17.5%. Underperforming its benchmark in that year-to-date period, in part because it has been a very challenging environment for your active managers, both in the US and international equity spaces. So a bit of a drag there, and the best performer for the year-to-date period down at the bottom of the slide there being your international equity index, which so far through November was up 28%. Any questions on November results?
Any questions for Amanda? Thank you. Move on to the preliminary December benchmark performance.
Switch those here.
So switching gears to December, we don't yet have official passport fund market performance for December, but just wanted to share benchmark results through the end of the year. And so we did ultimately end up seeing the Fed make a rate cut of 25 basis points in their December meeting. It wasn't consensus. There definitely was some dissent there in making that decision. So we still are seeing some questions around, what inflation looks like, what we're seeing in terms of labor market, but they did go through with that cut, which was their third cut of the year. On the equity market side, I think the biggest highlight in terms of where we land at the end of the year is the flip-flop we saw year over year between US equity markets and non-US. Certainly in 2023 and 2024, very much dominated by US equities, particularly US large caps. And here in the month of December and also the full year 2025, international equities outperforming US and particularly emerging markets. Emerging markets have been a little bit of a laggard the last couple of years. I think the last year we saw a real dominant year like this for EM was probably looking back to 2017. So definitely the standout for the year in terms of market results.
Thank you, Amanda. Any questions for Amanda?
So we do have set up.
Do you want me to, any questions? We'll go to the next
Any
topic.
questions for Amanda? Okay, then we can go on to Roy's report.
We'll switch from the backward looking to the forward looking. And it's my pleasure to introduce our colleague from the Goldman Sachs Multi-Asset Solutions team, Roy Appelman, who's moving to the podium now. Roy is, some of you might remember Roy from a couple years back when we did the last review of the strategic asset allocation pension. He's our head of research and was also very involved in that process, closely with the CIO and the BAM team at the time. And also came at least once to present to the board previously. So delighted to have Roy here today. He's going to share the outlook for our team within Goldman Sachs as we look forward into 2026, talk about what we're seeing in markets. Feel free to ask Roy any questions you have. The other aspect of this is a timely conversation as well to reintroduce Roy as we begin thinking about the next review and starting to kick off the strategic asset allocation review as we look forward. So Roy will also be involved in that process. So very fun.
Thank you. Welcome
Hey, Rick.
back to TRSNYC.
Okay, thank you very much, everyone. So thank you for the opportunity to share our outlook with you. The good news is that as we enter 2026, from a macro perspective, things look reasonably constructive. US-led, but actually also more breadth in terms on a global basis in terms of growth outlook for 2026. In the US, we think this is driven by several factors. The first is, of course, the continuous importance of AI CapEx, which at this point is large and significant on a macro perspective. The second is a shift in Q1 of this year to a more accommodative fiscal policy on a centralized basis from the US government. The third is a shift also in monetary policy, which, as people probably remember, shifted to be looser and more accommodative in September of last year. Finally, what's also important to note, the tariff uncertainty, which was a very significant driver of volatility in 2025, now seems to be a bit behind us. The other thing to note is that what we are seeing now is a more synchronized global growth picture overall. Probably best illustrated by the shift in Germany towards more significant fiscal spending that is expected to start flowing this year, but actually not limited there to that country at all. In fact, we're seeing more accommodative stance in Japan. We're seeing stabilization in China. And generally speaking, a shift to a more constructive growth outlook. Now, of course, the market already is pricing a fair amount of that in, and therefore risks remain. The risks that we are seeing still center on the labor markets. They have mitigated, mostly through the passage of time. So far, we seem to have gone through the peak points of uncertainty while the US labor markets have remained resilient. Far from stellar, very muted job creation, but also not enough to trigger a negative feedback loop into the overall economy. In addition to that, of course, as everybody knows, things are not cheap out there. And markets are pricing in a rosy outlook. But from our perspective, this is a headwind, perhaps to total return, should limit the amount of upside, maybe amplify risks on the downside if we do get a crisis, but is not a reason to underweight risk assets. So if we move on to page 4, I wanted to flag a couple of things that have really changed over the last several months, which I do think matters. The first is where we stand within the overall tariff pictures. The reality is that tariffs were a significant source of uncertainty in 2025. The drawdown of April of last year is still very much front and center in our minds. But at this point, it does seem like things have stabilized. If we look at how much tariffs are being collected relative to the overall target, at this point, we are quite close to the final numbers, which means that, at least from a collection perspective, most of this is behind us. In addition, when we look at the price of imported goods, we have seen increased pass-through to inflation. Of course, nobody likes higher inflation, but the fact that this has passed through with relatively muted impact to overall economic activity does suggest that much of this uncertainty is behind us. And then finally, the overall sentiment around tariffs seems to have shifted to a similar situation where we saw a lot of escalation in tariff negotiations to ones where more resolutions and more deals appear to be in the offing, and therefore, again, removing this source of uncertainty. Now, of course, no one can ever know what will happen next year. Things could change, but at least for now, this seems to be a more favorable trajectory overall. So if we move on to the next page, I do want to touch a little bit more deeply on the two sources. Sorry, are there any questions before I move on? Okay. So I do want to touch a little bit on the two main risks that we see right now in markets. The first one is the US labor market. This has been front and center for at least 6 months at this point, as job creation has been rather weak. We also saw some signs in Q3, early Q4 of last year to a potential further deterioration. But at least for now, we do seem to be stabilizing at the current levels. So not a lot of hiring, but also not a lot of firing. And if anything, most recent labor market data, such as initial claims that came in this morning, were actually quite strong. Now, given that the labor markets are a little bit backward looking, and we are looking at a more favorable outlook from a policy perspective and an AI CapEx deployment perspective, we do think it is at this point reasonable to assume that labor markets stabilize and perhaps even start to improve. However, given the level of job creation at this point, there is absolutely fragility there and is an area that we think is still the primary risk to the US economy. But at this point, it is just a risk, and we think the probability of it breaking declines as time passes, and therefore, from our perspective, is not likely to happen. The other core risk that is out there are valuations, particularly in the AI space. Anybody who reads the paper, I'm sure, has read a lot about this. I do want to flag a few things. Things are not cheap. That is absolutely correct. They're not cheap everywhere. It's not just in the AI space. But from our perspective, this magnitude of valuations probably presents a headwind to long-term returns. It does tend to amplify downside if we do get a crisis, but is actually quite a weak signal for near-term performance of equity markets, particularly one where you are seeing a reasonably constructive outlook to earnings growth, which is what we saw last year, and at this point also what we expect to see this year. So from our perspective, again, this is a risk. It is something to monitor and perhaps modify your reaction function if we do get a crisis, but at this point, not an obvious downside in the short term to markets. So if we move on to page 7, where does that leave us in terms of the outlook for risk assets? So starting with equities and credit. We're modestly constructive on equities. In the kind of environment that we're forecasting on a macro perspective, that is one that tends to be supportive of equities. Doesn't necessarily mean that we're going to get the same double-digit returns that we've gotten in each one of the last 3 years. But as long as growth holds, as long as earnings continue to be resilient, equities tend to do well. In addition to that, we do see some upside in equities beyond the AI space and on a global basis, essentially a more diversification, more broadening of the rally, the tailwinds in equity markets overall. We do have to emphasize that we think equities are a better way to take risk at this point than credit, not because we think credit necessarily underperforms on an absolute basis, but on a relative basis in an environment where things are expensive. Any potential upside will accrue much more to equities than it will to credit. And if one of our risks, for example, the labor market materializes, the convexity in credit is probably going to be felt a little bit more. I will touch a little bit more on private markets a little later on. We do see some weakness in the kind of more leveraged space in private markets, but again, not enough for this to be considered systemic on a macro perspective overall. So moving on to rates and effects. We want to emphasize that in our view, the only area where valuation is not expensive is actually rates. However, we think rates are fairly priced. Real yields are at levels that are consistent with historical compensation for inflation risks overall. Of course, debt sustainability in developed markets is a concern, but not one that is near term. That is more of a long-term issue. In the near term, that really is the only place where on traditional valuation models, things are not expensive. However, we do think things are fair. We don't see an obvious opportunity there, but we do think that rates remain an interesting asset class, particularly as a diversification for the type of recessions that would be more problematic in the future, one that are led by concerns around growth and trigger an overall flight to quality. We have seen already and continue to see a normalization in the interest rate markets from the pre-2020 environment we have been in. We have generally viewed most of this correction as healthy, with the curve slope returning to more normal levels, real yields returning to more normal levels. But at this point, we think we're there, and further increase in slopes in some markets, particularly in Japan, could be viewed as a little bit more problematic. In terms of effects, the dollar, we do believe, is a bit overvalued. Generally speaking, as rate differentials across the main developed markets continues to compress, we do think the dollar should depreciate modestly. But from our perspective, our view is that this is priced into markets. It is a potential modest appreciation. We don't necessarily see a real source of problem. So with that in mind, before I move on to private markets, I wanted to see if people have any questions regarding our outlook on public markets. Okay, so moving on to private markets. Private markets are definitely interesting in terms of what we are seeing. If you look at the chart on the left, in terms of deals that have already been executed and are in the ground, you can see on the chart on the left two interesting things. The first is the light blue bars, which is the current valuation of deals on the balance sheets of various funds. The second, in the dark blue bar, are the valuations in which deals have been monetized recently. The small sliver of red is essentially the difference between the two. Now, what you can see is that this has compressed over the following years, but unfortunately, as things have just gotten a bit more expensive. The second is that, generally speaking, deals have exited at slightly below the valuations in which they were carried. Now, this is not necessarily a significant problem, but given that we do think there has been a high quality bias in deals that have been exited as opposed to the deals that are still on funds balance sheet, we do view this as a little bit of a headwind on a forward-looking basis in terms of expected returns for private equity type assets in terms of deals that have been executed. The second chart here on the right shows our assessment of how new deals are being priced. What you can see here are two things. The first, in the chart here in the bar on the left, what we have plotted out is the historical range of realized EBITDA growth in excess of GDP that has been realized in the private equity space. Now, that next to it on the right, we have plotted what is our current view of what EBITDA growth would need to realize in order to achieve the historical return of private assets. The reason we think that this forward-looking EBITDA growth needs to be a bit higher than it has been historically is because things are expensive from a valuation perspective, and therefore it is difficult to count on any improvement in valuation as a tailwind to return. The second is that rates are higher, and therefore leverage is a bit more expensive. That means that in order to achieve the historical return of private equity, you need a roughly 10 to 15% range of EBITDA growth. This is a bit higher than has been achievable, not impossible at all, but does suggest that relative to history, there are a little bit of headwinds out there. and that also, frankly, differentiation in manager quality and manager outcome will be more significant. If I move on to private credit, of course.
Or is that based on teachers' holdings?
This is a general industry-wide market chart. On page 10, if we move on to private credit, as I flagged earlier, there are a little bit more issues out there in some of the more highly levered situations, particularly in private markets. If you look here at the chart on the left, I want to flag a few things. Generally speaking, you can bucket the deals in private credit and direct lending into three categories. The first category is what we've actually labeled as dark blue. Arguably, we should have flipped the colors. Is the category where at this point interest coverage ratios are below 1. That means that cash flow is not supportive of paying on its own the interest expense on those deals. The second are the set of deals which, when they come to refinance, may have trouble refinancing the full amount of debt and may need an equity injection. Those are the type of deals where perhaps the interest coverage ratios are above 1, but maybe not high enough to provide enough of an equity cushion when it comes to refinance the deals. Now, from where we look at this, what we can see is that roughly 15% of the market is in that first category of a decent amount of trouble. But that's 15% of the number in terms of number of issuers, and most of those issuers are smaller. So from our perspective, also frankly, this does not have to get resolved in a year. This tends to be resolved over a multi-year period, say about 3 years. So when you look at that and what that implies for defaults, generally speaking, this is a little bit above average, but not necessarily quite that bad. And it is consistent with the fact that we have seen default rates actually in the leveraged loan market start to come down. So from our perspective, if we look at the private credit markets, there's definitely still a period of adjustment. You are seeing more of a bifurcation where there is this significant cohort of more distressed companies, ones that are not just suffering from a higher interest environment, but also from a deterioration in fundamentals. That cohort is significant, but is not one that is large enough in our mind to create a systemic issue. Now, I know I'm running out of time, so I will flag just one thing more on page 11, which is real estate. Real estate has been an asset class that has been out of favor for some time, ever since 2020. We do want to mention that, at least in our view, this is an asset class where value is now starting to be created. We don't know necessarily that this is a 2026 theme. It may be a little bit beyond that. But what we are seeing in the real estate side are a few things. First of all, is that supply and demand are coming much more into alignment. The supply side is generally more muted at this point, and completions, as you can see on the chart on the left, are expected to decline in the coming years. The second thing is that costs of constructions have increased, which means that real estate assets, if valued on as replacement basis, may face some tailwind. And then the final point that I wanted to mention is that this has been an asset class where relatively muted amount of capital flows has moved in over the last 5 years. And therefore, as a result, there is just less capital chasing opportunities. So from our perspective, this is not imminent, but this is an asset class where we are starting to see a little bit more value building in overall. So with that, I've concluded my prepared remarks. Of course, happy to take more questions or hand it back to the board.
Yeah, excellent presentation. I'm concerned because I've been, my little zero EBITDA company gets about 20 calls a day offering me $100 to $1 million just based on nothing. And it's a lot of behavior reminiscent of pre-GFC mortgage crisis, right? You know, no income, no job, mortgages. And I'm seeing a lot, but your numbers saying, well, it's a bigger portion that might be in distress. I think that a lot of these, the newest bottom of the industry loans are not coming in as distressed. The collateral is being utilized for the third or fourth or fifth time, maybe by some, and we know that's happening already. So I'm really fearful of what's happening to my favorite asset class at this point. So I guess the general question I have for you is, if you're building me a multi-strat from grounds from as of today, what are you looking at? What's your breakdown
Breakdown for private credit.
in general, overall, as a, given that we might, we see we're gonna have to have a special moment in private equity to get where we want to be, right? Private credit might be having stress. Our savior has been, equities, passive equities. What do you look, if you're looking at us today and saying, where would you put someone today?
Yeah. So that's, of course, there's a lot I can do with that. So I'll try and be a little bit more consistent. So first of all, I will flag in private assets, we're not advocating for a special moment. We think there are some headwinds, but we think these headwinds also have a multi-year period to work through. They don't necessarily mean a crisis. They can mean returns that are a bit below what we've had on a historical basis. I would also flag that a lot of these companies, for example, on the private credit side, they don't necessarily have to default. Some of these will be recapitalized. Some of the debt will be swapped to equities. So there are multiple ways in which this can play out.
Big strategies cannibalizing our own assets too.
In a little bit. Now, in terms of an overall outlook for a multi-asset portfolio, generally speaking, we still think this is an environment that is modestly favorable for risk assets. As I said, the good news is the macro environment is relatively constructive at this point. As long as that environment remains constructive, risk assets tend to do okay. We are probably looking at returns that are not as high as we've seen in the last decade, but the last decade has been an unusually high return environment for risk assets, definitely on a risk-adjusted basis. So what does that mean? It does mean that we favor dynamically a little bit more equities over rates. We are looking a little bit to diversify into the broadening theme as opposed to just pure equity beta. Some of that is risk management. We like AI. We think AI has an upward potential, but the markets, our investment portfolio is concentrated in AI. Almost everybody's is. So can you find opportunities that are still risk asset favorable, that are not as sensitive to the AI theme, not because you're bearish about it, but just because you want a little bit more resiliency? Okay.
Thank you. I'm set. Thank you.
Thank you.
Now we move on to the public agenda pension fund performance update by Dan Haas. Thank you, Dan. All right. Wait, how are you? Good.
Okay. We're all set. Good morning, everyone. Thanks for having me. I have to say, I kind of feel like a comedian coming on the stage right after Jerry Seinfeld. That was really well done. Roy, I just took off, but I think you'll hear some of the themes that he raised in his macro perspective. We're going to be underlying it a little bit here. And really what I'm here to talk about today is a continuation of some of the themes that we talked about last month. We're in a period where we're seeing mixed signals from the economic data, and that's sort of muddling the path forward for policymakers, right? And there's an inherent conflict that makes it a little bit tougher to, just position, for effectively for the future. If you think about it, the S&P is bouncing off of its all-time high. All the markets are. It reached its most recent, 2 days ago, and it was barely newsworthy. Credit spreads are near their all-time lows, and that's an accommodative. It suggests that cash is flowing freely into risk assets, and investors are not demanding a super premium. We'll get into that a little bit later. But meanwhile, we still have inflation running stubbornly above the Fed's 2% ideal target. And as Amanda mentioned, the unemployment is still a bit stagnant. So it's, the job creation isn't quite as robust as we'd like it to be. So if we jump into the slides, I got a couple of familiar slides for you again today. But just to sort of underline and give you updates from what we talked about last time. If we focus on the top left, GDP prints, you see that we finally received the rest of the third quarter numbers. And you see that the US is showing some pretty consistent growth relative to its developed peers. So for instance, we look a little bit more like China in the 4% range than we do UK, Japan, and Germany, which are a little bit showing a little less robust growth in the fourth quarter. We expect the fourth quarter for the United States coming a bit lower. The Atlanta Fed GDP now suggests that we have a 2.7% print for the quarter ending December. And other sources show it a little bit below, somewhere closer to 2% actually. Those would be what they call their blue chip peer group. Next update, we're going to get that on January 22nd. So we'll see how that prints out. Moving over to the top right, again, Roy mentioned that job creation wasn't as robust as we'd hoped. November numbers are updated since we last spoke. Unemployment crept up by 0.2% to 4.6%. And the labor participation rate is also ticked up a little bit. You may recall that in December, we also took a look at the labor participation rate for prime age workers, those aged 25 to 54, which is showing a little bit higher. That came in at 83.8%. And again, that could be suggestive of either labor conditions tightening in that market because those are very near their all-time highs, or it could be an indicator of dry powder among the non-prime age workers. If we move over to, let's go to the bottom left. So inflation, again, estimates for November have us, again, kind of mid-pack among our developed peers. We're still a bit higher than the 2% target, as I mentioned, but not significantly. And then we're going to see December values on January 13th. We expect those to come in about 2.7% again. And then finally, on the bottom right, these are just currency rates. And again, the past, Steve, we kind of riff off of the trends here. What's interesting about this, though, is if you focus on the one-year numbers, the relatively high positive numbers. That suggests that it's unusual, and that suggests that in the first 6 months of the year, the dollar depreciated relative to all these currencies. With the exception of Japan, the Japanese yen was fairly stable, but it's a really nice tailwind for the international investments, and we'll see that a little bit later when we start looking at performance. Want to move into the next slide? So again, this deck is really kind of focusing in on key rates. The survey of official rates for the U.S. and a few other major central banks on the top right there. So as we expected, and Amanda mentioned, the Fed voted in December to cut its target rate to 3.75% by 25 basis points. That continues the decline we've been seeing since September of 2024, when rates were at their recent highs of 5.5% that you see there. So we're in the midst of a rate cutting cycle. We sort of talked about the unique dynamics playing out in the Federal Open Market Committee this year, the Fed Board of Governors that sets rates. Just keep in mind as we move forward, Chairman Powell's term ends in May. There's not any real clarity on who's going to succeed him. There's a few favorites, but in this environment, it's really tough to kind of handicap that. And then we also talked a little bit last time about the dot plots, the dispersion among estimates, forward estimates of where rates will be by members of the Open Market Committee. And now compared to historically, they're about twice, the spread is about twice as wide as they used to be. So there's a little more dispersion among estimates on where they think rates will be a year or 2 years or 3 years away. Next Fed meeting is on January 28th. And again, I think during that meeting, no one's really expecting any rate changes. It's going to be sort of a data-driven wait and see kind of messaging from that meeting. If we look at the next line there, the Bank of England, they're in the midst of a rate cutting cycle as well. They cut their rates back on the 18th of December. Policy rates aren't too far from ours. I think markets are pricing in another 25 basis point cut sometime in 2026. And then next line down, ECB, likely on hold. You notice that their range on their cycle, they topped out at 4% there. They cut pretty significantly in 1 year down to 2%. And so that was from, we'll say, June 2024 to June 2025. and consensus says they're going to be holding at 2% for the foreseeable future. Japan actually, market dynamics, we talked a little bit about that last month as well. They're actually in a rate hiking cycle. Again, they've had this structural low inflation or disinflation environment, low growth environment that's beginning to normalize. So they're starting to see some inflation now, and they're able to raise rates and normalize their economy a bit. Where are we here? Why don't we move down to the bottom left, the yield chart there. And again, I don't want to beat you over the head with this stuff, but the takeaways here, again, if we focus on the red line there, that is the yield curve as of a few days ago. And what you'll note there is that first, it's positively sloping, and second, that it's off the bottom of the chart, meaning that we have some carry, right? We're receiving compensation for investing in fixed income securities. And then the positive slope is actually a very good sign, just because it's what's known as a normal curve, right? Term premium is back. It's a sign that investors in markets aren't expecting, are expecting to receive more for investing longer out. It's supportive of growth, and it's an indicator that short-term rates are not overly restrictive. So good news there. If we contrasted that with the gray line, which represents the curve from 5 years ago in 2021, you can see that it largely parallels that, but it simply shifted upward by 3% on average. So it's sort of a parallel shift from there. Those other two lines are intermediate. It's a year ago and 3 years ago. What you see there are really kind of Fed actions playing out. I don't think we need to get into it right now, but a lot of technical factors were driving the short-term rates much higher than the longer-term rates, causing an inversion in the yield curve. We talked about that a little bit last month. That was 3 years ago, the blue line. When you move into the last year, you see that sort of normalizing, and you see the trend kind of continuing into the red. So again, good news for markets, a nice indicator. If we move over to the top right. So again, not much to talk about here. The corporate spreads, again, that's the amount extra you would expect to be compensated for investing in U.S. corporate debt, investment grade and high yield debt of U.S. corporations. The takeaway here is that the spreads, the amount of extra compensation you expect, are very near their long-term lows. Again, good news and a tailwind for the economy. It's a signal that investors are comfortable taking credit risk, and they're expecting stable economic conditions ahead. So again, a great indicator for market dynamics. And then as we look down toward the bottom right, I have a note here not to beat you over the head with more curve dynamics, but I will note that on that first section there, if you look at the current yield, the 2-year and 10-year spread at 71 basis points, again, not much change from last month, but I want to underline that the optimal or the normal range for that is 50 to 100 basis points. So we're right in that range, and again, if you're using this as an indicator as you look forward, it's a good sign. And then finally, we have mortgages. They're down 1% in the past year to about 6.25%. It's positive. It's a positive development for the housing market. They're still about 1% higher than their long run average over the last 30 years, but still, at least moving in the right direction. And then finally, a bit of a contraindicator with gold. You notice that that's up almost 70% since last year. And again, generally, that's an indicator of a flight to quality. People are looking, are anticipating market uncertainty, so they're investing in this what they perceive to be a fairly stable and resilient asset. I'm happy to take any questions you may have. That kind of concludes what I was prepared to talk about. Yeah. Okay. Great. Thank you.
Thank you. That brings us to the conclusion of our public session. Question before we entertain a motion to go into executive session. Do I hear a motion to go into executive session? been moved. Is there a second? Second. Thank you. All those in favor of going into executive session, please say aye.
Aye.
Opposed, say nay. Abstentions? Great, we're now in executive session. And Liz, you'll let us know when. Welcome, everybody. We're now back in public session. And we will have a readout from Priscilla Bailey. Hey, Priscilla.
Hello, how are you again?
Good, thank you.
Thank you, Mr. Chair. In the executive session of the Passport Fund, there were 2 manager updates, and this was followed with an update on the contracting of a service provider. In the executive session of the Pension Fund, there was an update on preliminary performance. There was a presentation on the 2026 annual plans for economically targeted investments. Consensus was reached. There was an update on the manager alert ranking systems for public market strategies in the third quarter of 2025. This was followed with an alternative credit presentation. Consensus was reached. The board heard presentations on 2026 annual plans for alternative credit and private equity. Consensus was reached on these 2 asset classes. Details to be made available at the appropriate time. Thank you all.
Thank you, Priscilla. I think that brings us to the conclusion of our public session. And as always, I thank Will, our recorder, and Adrian, our TRS tech, and also on the scenes, Liz, thank you for everything that you do. And is there a motion to adjourn? Moved. It's been moved. Is there a second? Second. Any questions, comments? All those in favor of adjourning, please say aye. Opposed, say nay. Thank you. We are adjourned. Thank you, everybody. Happy New Year. Yeah.
Mr. Chair, we do have one.
Yeah. Oh,